If you've asked how to save for retirement, you've probably received the exact same standard advice, but the mathematical foundation underlying that advice is broken. Advisors frame the choice between a 401k and a Roth IRA as a simple guessing game. If you expect your tax bracket to be lower in retirement, choose the traditional, pre-tax option. If you expect it to be higher, you should choose the Roth. These formulas show the standard algebraic proof. Relying on the commutative property of multiplication, paying taxes up front with a Roth or decades later with a 401k yields the same final wealth. The tax variables cancel out, leaving perfectly balanced, identical retirement funds. But this perfect balance relies on a massive blind spot. It assumes the IRS operates in a vacuum. By trusting this simplified equation, savers are walking straight into structural traps hidden deep inside the tax code. Every pre-tax dollar you put into a traditional 401k creates a silent partnership with the government. You take the tax break today, while the IRS simply defers their cut until you are most vulnerable. Eventually, the government comes to collect. Starting at age 73, the IRS dictates your withdrawal schedule through required minimum distributions, or RMDs, forcing you to liquidate portions of your account, regardless of your actual financial needs. This grid shows how the IRS calculates those mandatory withdrawals, using their own life expectancy tables. As you get older, the required percentage goes up. A 73-year-old is forced to withdraw nearly 4% of their account. By age 85, it's over 6%. For disciplined savers who spend decades building massive 401k balances, this creates a bizarre penalty. The government forces large, mandatory taxable events, turning your own compounded wealth into a tax liability. Urgent tone, these forced withdrawals trigger a cascading mathematical disaster known in retirement planning as the tax torpedo. To understand it, we must look at provisional income. This is the specific formula the IRS uses to determine how much of your Social Security benefits will be taxed. They add your adjusted gross income, your tax-exempt interest, and half of your Social Security benefits. Watch how this math actually plays out. Let's say you pull an extra $1,000 from your traditional 401k. That money counts as ordinary income, but because it raises your provisional income, it drags an additional $850 of your Social Security benefits into the taxable bucket. The IRS sees $1,850 of new income. This means if you sit in the 22% tax bracket, you aren't paying $220 on that withdrawal. You are paying $407. Your effective marginal HABS rate just spiked to over 40.7%. That neat algebraic equation from the beginning is fatally flawed because it ignores this exact scenario. Traditional 401k withdrawals trigger layered, cascading taxes on your other income sources. Roth accounts do not. A Roth IRA functions entirely differently. You pay your taxes today, but in return, the account completely insulates you from future required minimum distributions and the Social Security torpedo. Because withdrawals from a Roth IRA produce zero provisional income, your Social Security remains untaxed. It also protects your Medicare premiums from sudden income-driven surcharges. The government understands exactly how powerful this math is. Under the Secure 2.0 Act, the IRS now mandates that catch-up contributions for employees earning over $145,000 must be made on a Roth basis. A Roth account serves as an insurance policy, protecting your wealth from mandatory government liquidation and the unpredictability of future tax rates. If an employer matches 50% of your 401k contributions, you've secured an instant 50% return before the market even moves. Walking away from that free money is the single most expensive mistake in personal finance, even with the structural risks of the account. The 2026 optimization strategy follows a strict three-step sequence. Step 1 is to fund your 401k up to the employer match, capturing that unbeatable return. Step 2 is where you build your tax shield. Max out your Roth IRA up to the 2026 limit of $7,500. Step 3 handles the overflow. Direct remaining funds back into your 401k to hit the maximum annual limit of $24,500. Retirement planning comes down to a single decision about when you want to pay the IRS. You have to decide if you want to pay them today at a rate you know, or tomorrow when they control the rules.